Okay, this is going to be recorded. One thing I say at the beginning of all of these webinars is as soon as you get this sent to you, rewatch it again because it'll really make the strategy and all of the different types of little rules that we talk about really sink in. First time through, especially if you're a newer options trader, some of the little little things will really blow by you rather quickly, and you're also thinking of other questions maybe when we're talking about something. So it may go by you the first time. The second time through, it'll really sink in. First time, like I said, is short-term memory. Second time, it'll put it into your long-term memory. So please watch it again. This is going to be recorded, and this one's going to be on short call spreads. So I'm going to go through all of the different rules that I look at for this type of strategy, and we'll really break it down in this next hour. Anyway, a couple things we got to get out of the way. First, my name's Eric Wilkinson. Some of you guys may recognize me from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I've been trading my own money for over 20 years now. I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire, but I am here to help you take control of your finances, manage your portfolio, and most importantly, manage your own risk. And I talk about this quite often. You know, if somebody else is managing your money, they're taking a piece of that action. They're taking a little bit of a basis point or so out of it, even if it's a no-load fund. There's fees being taken out of that, and it really affects your overall yield. If you guys do it yourself, you get to keep that. You essentially end up paying yourself, and over the long run, that money adds up to quite a bit. But anyway, I've traded in most markets throughout my career. From the Chicago Board of Trade, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of those products, and in most market conditions, as you can see here. So I've been there, I've been through it on the floor and seen it pretty much all happen. I got to go over this disclaimer real quick. This basically just says any news, opinions, research, analysis, or other information contained here are provided by Approach Trader Strategies or associate companies and or employees is for general commentary and should not constitute investment advice or solicitation to buy or sell any of these security strategies and so forth. The reason why I can't give a trade recommendation, you guys, because I don't know your risk parameters and I don't know what's in your portfolios. And it would not be right for anybody that has been in this business to say, hey, this is something you need to put in your portfolio right now without knowing what is already in your portfolio and or what your risk parameters are. So I get asked a lot, you know, do you give trade recommendations? Do you give trade alerts? I really don't. What I will do is I will tell you exactly what trades I'm putting on, why I'm putting those trades on, and when I'm taking those off. And it is up to you guys to really decide whether or not it is appropriate for you, because I can't say it's appropriate for you or not appropriate for you without, you know, really digging into your portfolio and your trade history. So at the end of the day, do your own homework, and past performance is not indicative of future results. So just keep that in mind going forward. Something I have to say. Anyway, on to the webinar. This is on short call spreads, and it's a bear call spread, or it's going to be bearish to market neutral. The nice thing about this, or when you're selling strategies and collecting a premium for them, when you're looking at an overall buy and hold strategy, your probabilities of success, believe it or not, when you go and buy a stock is 50-50. And the same goes for if you're selling a stock. Or shorting a stock, I should say, it is 50-50. But the probabilities that we're going to be talking about with this particular strategy here, we're going to be creating something where your probabilities of success are about 70%. So that being said, you know, if you were looking at something that you thought was bearish or you wanted to get short that underlying, this is a better way to do it because your probabilities are a little bit better. You're not going to participate as much on the downside, but at the end of the day, we're looking at trying to swing for some singles, doubles, and maybe even triples, but we're not really looking to swing for that home run. As you guys may or may not know, in baseball, the batting averages are pretty low, and those guys that swing for home runs all the time are even worse. So you're going to have a lot of winners, but they're going to be less of a base percent, or you're going to have more on base percentage than you would if you were swinging for home runs, I should say. So that's why the short selling strategy is the right call for me. I'm not always looking to try and get that home run with these. A couple of things we have to go over with this is the essentials to success on selling premium on the short call spread. Picking the right strike. Now, how do we pick the right strike on this? We're going to be looking at shorting the out of the money call at the 36 delta, and then we're going to build out from there. We're going to be trying to get about a third the width of the strikes. So in a simplistic scenario, $1 wide, we'd be trying to get about 33 cents for it, right? Or if we were looking at something that was like a $5 wide, we're going to be looking to try and get about $1.66 for this. That would be about a third the width of a $5 wide strike. So 50 to 55, if we're shorting the 50 calls and buying the 55 calls to define our risk, then we would want to at least collect $1.66 for that. So that is going to be about a third the width of the strike. Sometimes, if I'm really bearish on the underlying, I will bend that rule to about 25%, but I don't like to collect any less than 25% ever. 33% is the wheelhouse and the best case scenario for something like that. Picking the right duration. We're going to be trying to do it within this 45-day segment. So we'd like to implement it right around this 45-day because we see the most decay in that options premium within the next 20 some odd days. Now, I'm not going to take this all the way to expiration. Some people talk about putting on strategies, short selling or shorting a call spread or something, and then collecting all of that premium and let it all decay out. At the end of the day, we're going to increase our probability of success by getting out of this a little bit early, and we're going to be trying to get out of it at around 50% of what our max profit would be. So if we collected a third the width of the strike, we're going to be trying to collect, about half of that premium that we collected. So we don't want to write it all. There's a lot of things that go on within this last 7 or so days. The gamma, which if you looked at options very much, really affects the delta and that 36 delta that I was talking about. So the more the smaller even the move is within this range, the more the fluctuation in that premium is going to happen. So I'd like to be out of that relatively early, not have to deal with it, and increase my probabilities of success by doing that. And picking the right environment. The right environment is selling a call spread in a high IV percent environment. And I will go into that in detail when we pull up the options chain. But we want high implied volatility, and we want that to be in the upper 50% of where it has been over the last year. Now for ETFs, because it is a composite of several different underlyings within that ETF, that is going to smooth out that volatility within that ETF, so we can lower that to 30%. So if we're doing a particular underlying, it's got to be above 50% implied volatility percent. And if it's an ETF, we can lower that standard just a bit, because you're never really going to get too often where that ETF has a super high implied volatility percent above 50. So something above 30 on an ETF is the rule that I follow. Picking the right underlying. We want to make sure that this underlying has a lot of participation in there. We want a lot of players, as we used to call it on the floor, involved in this particular underlying, because the bid ask will be much tighter. If you have people fighting over trying to get that trade, that's going to bring in that bid ask. And the reason why, if you use something that an underlying that you have a lot of knowledge in, but there's not a lot of participation outside of you being in that market, you're going to have to give up more edge to get in, and then you have to give up just as much edge to get out. Meaning, say on a $50 underlying, the bid ask could be 30, 40 cents wide. That's a lot to give up to get into that trade, and it's a lot to give up to get out of that trade, because those people aren't going to be as willing to pay up a penny or two. You're going to have to be giving up nickels and dimes, and that will eat into your overall profit. If you can give up only a penny, then that's the way to go. And I'll show you all of this stuff on the platform when we get into it. And know your exit strategy before entering the trade. Know that when you're going into this short call spread, we're looking at a target of 50% of our max profit. We would like to get in and out of these because we'd like to reallocate that margin somewhere else, rather than just letting it run out to the bitter end and taking on that undue risk, especially towards or near expirations. We want to increase our probabilities by getting out early. Now, the max profit on it, anytime you're selling and collecting a credit, your max profit is that premium you received, of course, minus your commissions paid. So whenever you're doing a short, collecting a credit, shorting a call, or a put spread for that matter, that premium you received is the max profit. But like I said, I'm going to be looking at 50% of that max profit to get out. And your max loss is going to be your long strike minus your short call strike, and then minus your net premium received. So the width of that strike, and then we subtract that premium received. So in the example of, let's just for simplicity reasons say a dollar wide strike, our max profit we're looking for would be that 33 cents, because that's our rule. We want a third the width of the strike. But our max loss is going to be 67 cents, right? Because the width of the strike is $1 wide. We subtract the premium we received from that dollar, that's 67 cents. Same for like a $5 wide strike. We have $5 wide. We collected, say, $1.66, because that's about a third of it. That would be our max profit. Our max loss would be the $3.34 from that. Does that make sense to everybody so far? All right, good. All right, and our break-even point is going to be our short strikes. So in that example that I was talking about, if we shorted the 50 calls and bought the 55 calls, and we collected $1.66, then our break-even point is going to be that short strike, which is the 50 calls, plus the net premium we received, which is $1.66. So when the underlying trades up to $51.66, that's where our break-even is. Anything above that is going to be where it starts to lose money. Now, a lot of people go in and say, well, that doesn't seem like, it's very good to let it ride out, and how do you defend this? Well, the probabilities, we're going to talk about this also. If we're looking at a 36 delta, like I said, that's where we're going to initially start to look to sell our short call, the 36 delta. That probability of success, is about 64%. The probability of touch, of that market coming up and touching our short strike, is double what our delta is when we initiated the trade. So if we initiated this trade with our short call being at the 36 delta, the probabilities of the market coming up and touching us at that 50 strike is double that. So it's going to be about 72%. So the probabilities of it coming up there are pretty good, but we have to play the probabilities just like in cards and everything else. You know, you've heard about playing the probabilities out. You need to let this probability play out. And the probabilities of it being in the money at expiration is about, or being in the money at expiration is only about 36%. The probability of it being out of the money is about 64%. All right, so enough of the boring stuff. Let's get into the trade platform here. Oh, I got it on the wrong screen. Can everybody see this slide over now? So let's look at this. All right. Why, Judy's asking, why is it double? It's kind of like a known. That's why we looked at it. Are you getting a different chart? Does everybody see the options chain here? Somebody's asking about the cloud. That was something I was playing around with. I was on a talk with 4 or 5 other traders, and they were talking about that. I've never really used it, and I just wanted to see what it looked like and play around with it a little bit. So, you know, I'm always learning too, you guys. So, yeah, Andrew Keenan, he's from the floor too. He was actually the guy that was talking about it in that thing that I did, and that's why I was kind of looking at it. So, the double question. So, for instance, this isn't going to be probably an example of something that we're looking at, but these are the deltas over here. So the probability of this underlying coming up and touching the 105 strike is about 50%, and it's double that. And that's something that we always did on the floor. We do everything to try and make it quick and easy so you can figure it out. So that is just it's kind of like in geometry, a given, if you will. The probabilities of it touching here and testing me is about 50%. But the probability of it being out of the money at expiration is about 75%, which is 100% minus the 25% is 75%. The probability of this strike being in the money at expiration is 25%. So those are how you figure out the different types of probabilities on this. So that's the quick and dirty way to figure it out. All right, so that's what we're talking about there. All right, so now I said on this that we were going to be looking at something that has the current IV percent. This is implied volatility percent is 24. Now I said on any particular underlying that we needed 50%. So this immediately would get stricken from my list of opportunities to implement this strategy. And as you can see, I look at this IV percent first. I don't even care what the underlying is when I'm first looking at something, and I put it up over here. You can go to the gearbox and type in implied volatility percent and add that to your watch list. And I have it sorted from highest to lowest. So the first thing I do with any strategy is look at the implied volatility percent. If I'm going to buy, then it's got to be really low. I mean, super low, because when you're buying, this will not decay as much as if you have high implied volatility. If you were to buy something with really high implied volatility, as soon as this starts down ticking, you're losing money. You could be directionally right and still lose money, which is another reason why I like to sell and collect a credit, because I like to watch this implied volatility downtick, and I can be directionally wrong and still make money. It also allows you to get further away from where the underlying is trading. The higher the implied volatility, the further away we can implement this strategy And when implied volatility reverts back to the mean, means normalizes, then we are going to be able to collect premium even, or we are going to be profitable even if we're directionally right or wrong, excuse me. So if we can get further away, volatility compresses, the market can be rallying towards us, but that premium is going to decay quickly. So that's why you don't want to be buying in high implied volatility environments. We want to be selling premium in high implied volatility environments. Not much volatility now though, correct? There isn't. And I've been struggling because we also don't want to sell this call spread like on LinkedIn, where there is going to be a earnings event going into it, right? So for instance, I have this strategy on from one of our webinars, but you can see from here, the next monthly cycle is basically where that earnings event is going to be, you know, embedded. So as implied volatility goes up right in here, you can probably tell this is likely 28 days from now where LinkedIn is going to have its earnings event, because it has the highest implied volatility right there. Just another little cheat to figure out where the market believes the earnings event or the earnings are going to be released is right there within 28 days of now. When you're doing, do you need a lot of margin when you're playing a bear call spread and or a bull call spread? The bull call spread, you're going to have to pay the money. So, and I'm going to show you a couple of examples where it could end up being about the same thing, but your margin is going to be that risk that you're taking on. So they're going to ask for the margin for your max loss. And that is it, because when you're selling a call and then buying and defining that risk, you can't lose any more money if XYZ, we sold the 50 calls in the example, bought the 55 calls. You can't lose any more money once the underlying trade's 55.01. So you've defined your risk. So the margin is going to be that $3.34 because we collected $1.66. Our margin is going to be $3.34. Does that answer your question? So this makes it great, especially for somebody that doesn't have a lot of money in their account, or if it's in an IRA, it makes it IRA appropriate. You know exactly what your max profit is, you know exactly what your max loss is, and you don't have to have as much margin. You know exactly where your margin is going to be. So that's where they're going to get you, is where your what your max loss would be for your margin. So for instance, like I said, on the 28th is when LinkedIn is, so that falls right in that options expiration that I showed you there. Bullish for earnings on Love, is that still the same? I'm going to let it ride out. Yeah, LUV, I haven't changed anything with that. I've got those on, and I'm going to let it ride into the event. You know, anything can happen from there. So usually when I'm putting on these strategies, you know, I've made my bed and I'm gonna stick with it. So I lowered my cost basis by doing that with that LUV, and I'm gonna let things play out. I'm playing out the probabilities always. I try not to. The only time I really change my thinking on stuff is, you know, maybe in oil or something like that. If Iran all of a sudden came out and said we're going to comply with OPEC, then I would completely change my thinking on something like that. But until that happens, I'm probably not going to. So, and I'm still in the same boat that I was before for the most part. Does that answer your question? So you sell a call with with what volatility you use, high or low. When I sell, if I'm selling any kind of option, I need high implied volatility. And that high implied volatility means above 50% for a particular underlying, or an ETF above 30. Okay, so as you guys mentioned earlier, there's not a whole lot to look at here above 50%, and especially things that don't have earnings. Google has earnings falling in there. As a matter of fact, Solar City has earnings. I don't know why it's not showing up there, because that was going to be one of the examples I kind of looked at. But if you flip onto here, it's saying it's questionable. So for instance, it doesn't really know exactly when they're going to come out with their earnings. They're guessing that it comes in on 5/5. And if you look at the options chain, you can just go over here and see where does it get the highest and start falling off right there. Well, this May contract has got the highest implied volatility, and then it starts going down. So you could assume that it's going to land within this May expiration. Maybe not necessarily this, but most likely right here. So you would want to stay away from that. Market is going, yeah, in implied volatility, great question. Miguel said, the market is going up and VIX is low. Generally speaking, when the market goes up, implied volatility goes down. When implied volatility goes up is usually either just before the market crashes or as the market crashes, the implied volatility spikes. And the reason why that happens is because the market, or implied volatility, is pricing in fear. And when people are buying puts, that means they are protecting their downside because they're becoming a little bit more fearful of the downside. So when people are buying puts, they're pumping up the premium, and that creates implied volatility going higher. So somebody's asking about Lululemon. You sell a call in that, and at what price? I'll look at that in a second. We can look at it right now. So let's look at Lulu. I don't have anything in Lulu, and full disclosure, I do have positions in some of these. I'm not trying to get you guys to jump off the cliff with me as a lemming, but the problem with Lulu is, it just had its earnings. So you can see what happens after earnings is this implied volatility just free falls. And I've done some webinars on earnings trades and taking advantage of that, because that's what I would love to see as soon as I implement a short or collecting a credit or short call spread, short put spread, iron condor, whatever. When I'm collecting a credit, I want to see this implied volatility fall off the face, because that allows you to get out of that strategy quickly, because implied volatility pumps up premiums. It doesn't allow your time decay to happen. So as soon as that implied volatility comes out, all of that theta or all of that time decay comes out rather quickly. So with Lulu, I probably wouldn't implement this strategy because of the low implied volatility percent. And one thing I want to talk about real quickly is, how is implied volatility percent calculated? The way it's calculated, and it's probably very close to the algorithm that that TOS here and or anybody else comes up with, it's where it's trading now. So it's trading at, say 12%. There's a numerator and a denominator. On top, which is the numerator, the bottom of the fraction is the denominator, right? So on the numerator, you take where it's trading now minus the high, or actually the high minus where it's trading now. So you'd subtract that out, and then you divide that by the high minus the low, and that's how you come up with your percentage. So this would be in the lower end of that. So that's the way that's calculated out, or you can just look at it on the trade page. For Lulu, it's at 9%, because going into that unknown binary earnings event, there's a lot of uncertainty, which uncertainty creates implied volatility, and people buying those puts creates the implied volatility. After the event, everybody knows it. What's happened has happened. There's no unknown really in the near term, so that implied volatility really comes out. But having said that, you guys can start throwing out some ideas of stocks you want me to look at, and we'll start going through the process of figuring out if it would work. So please jump into that questions box and start throwing out some ticker symbols that you guys want me to look at. Like I said, so we don't have a whole lot of stocks that don't have earnings. CMG is getting popped up. It's right here, high implied volatility. It does have an earnings event coming up. I would be bearish CMG just because of that whole E. coli scare that they were having. You can look over here and see when the earnings event happens. I like to try and do these strategies with 45 days, like I said, which would be the May contract for a perfect world. But we're going to have this strategy on through the earnings event. Heading up to that earnings event, we're going to probably see this implied volatility keep creeping up, just like we saw in Lulu, or heading into, say, this earnings event. You can see for even several weeks ahead of time, even a month ahead of time, it's just slowly creeping up. So we don't really want to probably implement this strategy with Chipotle, because we're going to see this implied volatility creep up to where it is normally going into that event. So that would hurt us. We could be directionally right, but if implied volatility starts pumping up, the more it pumps up, the more those premiums increase, and that is going to hurt us. It's not going to allow that time decay come out. So how does one trade Lulu now? I would probably, if I were bearish on Lulu, I'd probably buy a put or something along those lines, something cheap, because it's so, the implied volatility percent is so low that you aren't going to get that theta decay happening very quickly. So that's probably how I would play Lulu for that trade, Cindy. Does that make sense? A couple of other people are throwing out Facebook. I got a few people wanting Facebook. Facebook, I think, has earnings coming up in the next event, and it's got low implied volatility. Now, Facebook has a tendency to really rally into the earnings like this. This was those August lows, so that was a little bit outside the norm. But as you can see, going into the event, well, it kind of sold off here. I can't really see it going much lower than this heading into that event. I would only really believe that this is going to start increasing over the next week or so. It's probably on the 10th or something like that, or the 27th, 10 days after is what I was thinking, the earnings. So I'd probably kick that one to the curb. Somebody's also asking for Dollar General, super low implied volatility. I'm thinking we're probably going to have to start looking at some ETFs. I had a put on in last earnings. The stock went down $13, but received very low premium. Yeah, so that's a good example. If you're buying, well, I don't know. I'm assuming you bought the put on CMG. But if you bought a put, if you're doing an earnings play, you guys, I mean, please don't buy options for earnings plays, because that's when implied volatility is the most, and you can be completely directionally right and not make money when you're buying options right before an earnings event, because all of that data comes out, and you're going to lose your entire premium. So it's just not going to work out 90% of the time. And OS says you used to use straddles. Yeah, straddles are hard, so are even strangles. I mean, strangles work a little bit better, but straddles, at the end of the day, you can't have much move. You got to be inside that market maker move in order to make money for that. But selling option strategies around earnings is the best way to do that. And I've done a webinar on that to do those, and they, I almost wish that it was always earnings season, just because I love trading the earnings the most. All right, how do I determine what to put on my watch list? Great question. I have to have something that has, if you look at these, most of these stocks are going to have a lot of players in them. You see like Netflix, ADM, and what I look for instance, with Dollar General, I can probably tell you it's going to have pretty wide bid ask. For a $100 stock, 15 cents isn't too bad. But I like to have my bid ask around 10 cents for this. So if we were to look at, say, for instance, Apple, which is a comparative stock in a sense to that Dollar General, look, 3 cents wide versus 15 cents wide. That means with Dollar General, I'm going to have to give up 10 cents getting in, 10 cents getting out, whereas this, I'm going to have to give up like 1 or 2 cents to get in and get out from the bid and the ask, because you're usually not going to just put it on the ask. You're going to kind of go mid-market, and mid-market on Dollar General versus Apple is a big deal. So that's how I determine that. It's got to have a pretty tight bid ask in order for it to make my watch list. Rig has gotten, I've had Rig on there forever and just watched it go to nothing, but it's been left on there. It's still made the cut. Someday it might go up. So let's start looking at some things where can you sell premium before earnings but get out before the event? Usually not, but I'm putting on my earnings trades. So for instance, if the earnings come out either in the PM at that day or AM the next morning, that's when I'm going to put on that earnings trade, and I'm usually putting it on in the afternoon, and that way I capture the right market maker move and everything else. But you guys, we're getting off subject here. Check out that earnings trade webinar because I go over all of that stuff in detail. But this, for the short calls, we got to look for high implied volatility. None of these really have it. We're now below 50, so now we have to start looking for the ETFs over here. And I got to stay above 50 for these ETFs. It's one of my rules. So we can go down. Looks like UNG, which isn't really an ETF, but might be able to make it. Let's see. I think GDX was in here earlier today. Did GDX fall too low after that rally today? Let's just do it the easy way because I had looked at it. GDX, didn't see it in there when I was scanning down. 45%. How did I miss that? It must have been much higher. So GDX is an ETF. It's above 30. So, it's trading around 20. We can look at the chart. It had a big up move today. I also am like the contrarian idea where you have a big up move one day. That's when I'm going to be kind of looking at this whole type of strategy. And somebody's throwing out ABX. I'll look at that in a second. But GDX, so we've had a pretty big update. It's trending sideways. So in a sense, I mean, it's had some big moves with whether or not the Fed is going to ease some people talked about it easing, but raise rates and things of that nature. So with the good economic data today, it could be the other way around where we start tightening and the market could see this go down. So go into this, see where our bid ask, we want to try and go 45 days-ish. So, for a $20 stock, 4 cents wide is not too bad. I don't like to go much more than a nickel on something less than $50. So this would fit the bill. We'd look at maybe the 20 or the 37 delta, that's close to 36. So if we go for $1 wide, we're going to sell the 37s, go for $1 wide, not going to give us, it's just meeting my minimum requirement of a quarter. 33 cents would be the best, but a quarter kind of works in a pinch. One thing I want to talk about real quick, some people we were talking about buying option strategies. So some people go in here and say, for instance, would, buy the puts. So, on this similar strategy, if you're going to go in and buy this put spread that's in the money, people that buy in the money put spreads, and then build it this way, as you can see, wait, did I do that wrong? So I'm buying the 37s and selling the 27s. I'm getting a credit for that. So this would be usually a debit spread. So wait, so I wanted to buy these, sorry. Buy these and then sell those, right? Bearish, so you're getting a credit for these, but this would be the same thing as selling the call spread out of the money. And your probabilities of success are going to be better if you are selling this and then buying these, because you would actually be buying these and then selling these. So that would be the same idea as selling the call spread, but your probabilities of success are going to be much better by selling the out of the money call spread than doing it the other way around with the puts for the same directional assumption. Does that make sense for everybody? I just saw somebody talking about buying in the money put spreads, and I was like, the probabilities of success of selling the out of money are better. So that's the way I would set it up and try and get a little bit better than a quarter. You can work this where you would enter the market a little bit higher and then play with it, kind of let it work itself out, especially on a day like today where the market's starting to rally. Start a little bit further away and work your way down to get in there. So on to the deltas. My probability of this being out of the money is 63%. The probability of GDX coming up and testing my 21.5 calls is double this. So it's going to be about 74% probability of it coming up and testing me on that. And I'm okay with that because I know that that's where the probabilities lie. So that would be something that I'd be willing to do in a pinch to put this trade on. Say it again. What was that? Right. Somebody was asking to say something again. I'm not really sure. Okay, so GDX would be something that I would be looking at doing this strategy on, and then let's look at it from the perspective of, I can look at this and see I'm getting a credit of 28 cents if I were to get that price. So my margin is going to be 72 cents. So if you do that, you can look it up, 72 right there. So that is where you're going to have margin for that. Judy, I kind of got into that. I don't want to confuse anybody, but if people are buying in the money put spreads, your probabilities of success are better to sell the out of the money call spread. Just the probabilities work out better that way. So that's why I would do that. So, if you're going to be doing it in the money, it just gets a little wanky. The decay happens faster. You also have bigger deltas usually. It just starts having, this gamma is going to affect these deltas much greater than you would in your counterpart on the calls for the most part. Does that make sense? It's just better to do selling strategies out of the money than buying strategies that are in the money. So I would be selling the out of the money call spread in GDX on the 21, 22.5 call spread for this particular strategy at about 28 cents. That makes sense? The other thing we could do is look at if it would behoove us to maybe go out to $2.50, which would put us at the 30 or the 24 strike. See if we can get a little bit better. 50% or 50 cents on a $2.50 isn't going to make it within my third the width of the strike, or even my 25%, because I would, if I were to go to about 25% of $2.50, that would be about 60 some cents. So that's not even close. So that wouldn't work out. So that risk reward doesn't work, but the dollar wide probably would. And I can tell you that the $5 wide risk reward is not going to really work. You need a bigger underlying for something like that. Does that make sense to everybody so far? The other thing we could do is look at, say, XME, which is similar to those, but the this is the miners, the people that are actually doing the work, or the companies that are actually doing the mining, and it's at 50%. An ETF that's at 50% is pretty darn good. So I would look at the 30-ish, 36 delta, that's 34, so that's close enough. So I'd want to sell that one, hold down for the control to buy it. So it's 25% meeting the minimum. So that one would work out for us. So that would be another strategy that we could look at implementing this strategy in, because it meets the minimum. So in a pinch, and I would go through several different underlyings to try and find the right one that fits the 33% of, or the 33% rule, but I won't go any lower than the 25% rule. It's just going to get kicked to the curb because I'm risking way too much for the probabilities. So keep it within that range. 33% is perfect. And like I said, the more implied volatility is getting pumped into these, the further you can get away from the at the monies. So with super high implied volatility, you're going to be able to get a lot further away from where it's trading, and it'll give you a lot more room. So with this one, you can see that the 21.5s would be the high of this move here. So the 21.5s, if I could, would put me at the 22. So that would make this, for me, a little bit better. Sorry, my control button didn't work. Because I'm above where that high was, so I could look at that and say, all right, well, I'm in a pinch. I want to put on a strategy. This is the high. This is where the most volume and time has been spent for XME. So this is market profile with monkey bars added in there. And this is kind of the comfort zone. This is where everybody has been trading. That's where they find value. I would foresee that would act nicely. So, anything above this 21.5 would be a good risk reward, because that's, to me, is going to act as a resistance area. So that gets into the charting and stuff like that. How are you using volume price chart? I just look at it for, it's kind of, all of this stuff is psychology of the market in my eyes, and the more people that use these things, the more it comes to fruition. But this is just telling me this is where the most time and the most time this underlying spent, and where the most people are putting their money where their mouth is, right? It's trading right here. That's where the most volume's been traded. That's where people perceive value for XME, and it could be XYZ for that matter, but it's going to always want to really migrate to that that area. NASDAQ is trading right there at its value area right now, so that's why we've kind of seen a sideways trending market in NASDAQ too. It's right there at the value area, so people are comfortable with that. So that's a market profile superimposed. This is the volume profile, yes, with it's the monkey bars with volume profile right here. So you can see what the monkey bars are right here, and then volume profile. And I didn't change anything on these two, I just put them in there. And these little numbers are the time frames that it's traded at, and then the blue is where the volume has happened. They don't always they don't always land right on top of each other, but for the most part they do. That makes sense for everybody so far? All right, good. All right, so I'll go over this one more time with the deltas. We're looking for the 36 delta or something very close to that. 35 delta, 34 works, and then we're trying to get a third the width of the strike. So for instance, with this one, again, we would be selling XME right there, and then we would be buying XME right there, try to get the 25 to 33% the width. It's easy to do it on a dollar wide, right? 25 is 25% of one, and 33 would be of the other. Not that we would do it, but just for an example, something like, I don't have any CMI, Cummings, 10 cents wide on $100 when that meets my parameters on this. So as you can see, for the example that I was talking about, when there's, with this one, it's below 50%. So look at this, our delta, the one that we would be selling, which is in that 35-ish wheelhouse, 32, is right there, really close to at the money. I mean, it's only $5 away, and CMI can move $5 rather quickly. So we would be selling right there, very close to at the money, which is why you want the implied volatility to be pumped up, because you can sell it further out. All right, does anybody have any other questions? I know we kind of went over a lot, got a little bit sidetracked with earnings, things of that. I know a lot of people want to talk about earnings, and you know, with this low implied volatility, you guys, you can go and check at Pro Trader Strategies. We just did one on setting up earnings trades. I know somebody mentioned it about LUV. I did an earnings setup trade for that, where you're using these front months to actually finance when the event is happening, so you can take advantage of that. So for instance, with this one, we'd be selling something close and buying the other ones. But if you have those questions, I've done earnings for the earnings setups, and now when there's no earnings, how to take advantage of that. This, we're going to be doing the ETFs. I'll be looking at implementing these on Monday. I'm probably going to look at doing GDX, XME, and putting both of those call spreads on, so you can watch the daily market commentaries, you guys, because I talk about when I'm putting these trades on, and when I'm taking them off, how I'm defending them and stuff like that. Cindy doesn't understand the Lulu trade. Well, Cindy, I kind of breezed over it because it doesn't fit with this webinar. But I was saying the only thing that I would do here, probably, especially if I was long Lulu, would be buy puts, because implied volatility is so low. I would only be buying puts, or maybe if you were bullish, buying calls, because the implied volatility on Lulu is, I think it said like 9. This, given the detail of 8.62. That's the other thing is on the options chain, this rounds it up, and that's why it's given 9% versus 8.62. So with Lulu, something like that, I wouldn't sell a call spread in here because, you know, on this one, I'm right there at the money on the 70s. I mean, it's $1.50 away, and you know, you can see it even moved $1 today. So to sell a call that close to at the money, it doesn't work for the risk reward on this. You know, I probably would be able to get on a $5 wide here. You know, it's close. I mean, $1.25 would be my minimum. $1.66 is perfect. But the fact of the matter is within the next 49 days, it's expecting at least a $6 move. I mean, I'm almost sure that I'm going to get hit on that. Lulu 3 months out. I don't I guess I don't understand what you're talking about there. Could buy 38 Delta Strangle on Lulu 3 months out. Oh, yeah, you could. You could do that. I'm not a big fan of doing that. I mean, I'd probably rather do something like at this point in Lulu, do the earnings setup for the next earnings event, where I'm going to be selling something real close now and then slowly rolling those shorts out in time and lowering my overall cost basis, which is what I talked about in that earnings setup, earnings calendar setup, right? So that's why you got to have the high implied volatility, because with this, you're just selling at the monies basically. And, you know, my probabilities of getting touched on this are 90%, right? We said it's double the market maker move. So, you know, the likelihood is I'm 90% chance of this going into the money. So it doesn't work for me on that. Even though, you know, I can get my credit that I want, but that's because you're so close. All right, well, you know, I guess that about wraps it up. I think I pretty much covered everything, got your guys' questions out of the way. I do appreciate everybody throwing it back. I love the back and forth. Makes this go much quicker and much better. You know, and I appreciate everybody sticking around on a Friday when you want to get out of here, you know, TGIF. And I didn't throw you guys any loopers on the April Fools. But anyway, this is the trial offer we're doing. You know, we get 1 month for $7. You get the daily market commentaries like I talked about. I talk about these strategies that I'm putting on. I talk about implied volatility. I even go into the details of the economic data. You know, we had all that ISM number, or the ISM Institute for Supply Management Purchasing Manager Index stuff, and I go into all those details, what I see in those numbers, and really drill down, even like with the unemployment number today, and how there was like more hiring, but the unemployment rate went up, and or why all that stuff happened. So I go into detail on all of that stuff, talk about my trades, why I put it on, when I take it off, how I defend them, talk about the data, I talk about geopolitical, economic stuff in there, and what I see, how that's going to affect the overall markets. And then you also get the options trading lesson videos, which are like these webinars, but they're jammed down into about a 15-minute segment. Cindy, hopefully somebody can throw in a toll-free number for you. I think I've got it coming up somewhere. You can also just email us at trading@protraderstrategies.com. But then you get these live trading workshops where I drill down on, each individual strategy that I like to do and talk about my rules, how to implement those, and then work them out through the different platforms. So check those out. You can go to protraderstrategies.com, sign up for it, or you can look in the chat box. There should be a link there for you guys that gives you the direct link to this stuff. And I don't know, sorry, Cindy, I don't have our toll-free number right here. I thought it was on here maybe, but you can also, like I said, email us at trading@protraderstrategies.com. Somebody can set you up. You can also call us at 310-598-6677. This is that link to the webinar offer. And please write to us and, give us some ideas. I'd love to hear what you guys like to use, and then I can figure out a couple of different strategies or tell you what my rules are around that. And if you guys are signed up for this and you guys have a strategy that is testing you guys or isn't working out, you can write me. I am more than willing to talk to you guys through this and tell you what the different rules are that I would use and how I would take on that strategy. I can't tell you what I think you guys would do, and that goes back to the very beginning of me not being able to know what's in your portfolio or know your risk parameters. But if you guys ask me, hey, XYZ is testing me here, what do you think I should do? I can't tell you that, but I can say, hey, this is how I would approach this strategy. This is how I would approach this scenario, and this is how I would defend it and or trade that. So please reach out to me on any of those kind of questions. I'm more than willing to go back and forth with you guys. Yes, Mohammed's asking, do we offer packages for newbies? Absolutely. And stick with us, because we're going to be kind of going over this again, where we're going to be starting out. This is a rather basic strategy, and it's appropriate for IRAs. It's appropriate for the newer trader that doesn't have a ton of money in their account. And that's the benefit of trading options is, if you're going to buy 100 shares of Apple or something like that, you got to have a lot of money in your account to be able to do that. Options allow you to trade with that same size in a sense, but with less margin. So we're going to be doing that over the course of the next few weeks, and we're going to kind of incrementally step it up, where we're going to get into more detailed strategies or more advanced strategies, I should say. So go to ProTrader Strategies and sign up for it. Hopefully we can get some implied volatility spiking, and we'll have a lot more options to trade. So appreciate it, you guys all. Thank you for your time, and that's all I got for you today. If you can't take that, take it easy. Have a great weekend, everybody.